Are you feeling squeezed by taxes, uncertain about the marketplace, wondering where the heck all the money is going? Well, you're not imagining things. Canadian families are now shelling out 42% of their income to taxes. Meanwhile, Ottawa's running record breaking deficits with no budget in sight. And check this out, over $83 billion worth of investment has left Canada in just the last 4 months, as investors are now betting on the US. And real estate, yeah, it's in the crosshairs. Toronto's condo market is overflowing with unsold units. Vancouver rents are shifting fast, and so-called government relief in housing, they're just really repackaging debt. This is what's important in real estate this week. Let's break it all down. Starting off with taxes, okay? If you feel like you are paying more taxes than ever before and it's becoming harder and harder to get ahead, well, you're right. And here's the data to prove it. The average Canadian family earning a total of about $114,000 now spends $48,000 or 42% of every dollar they earn on taxes. This is according to the Fraser Institute's tax simulator. This is up 181% since 1961 after accounting for inflation. What's worse is Canada is currently running without a budget, and one is promised, but not until fall. Early projections show as much as a 92% deficit, $92 billion deficit. It was even hard to say. And that will be required this year. And outside of COVID, that is the highest deficit the country will be running. But just recently, we also saw a Ministry of Finance document that you can see on the screen here, suggesting it could hit as much as $147 billion deficit. We'll know the actual numbers in fall, or at least the projected ones, but either way, expect it to be one of, if not the highest deficit this country will run in history.
Welcome to inflation. Unfortunately, it's funny. You know, people are wondering why the Bank of Canada won't cut. I think there's a pretty good reason right here. If they're spending like this, they're the only ones spending in the country. I can tell you that too, which is very interesting. And that leads to the next point. Investment is straight up leaving Canada. It's irresponsible spending, among many other reasons, including the lack of productivity. That has both Canadian and international investors continuing to move their money out of Canada. According to StatsCan, that tracks Canada's international transactions in securities, $83.8 billion has left Canada since February, and 90% of the money is moving to the US. 83.8 billion just evaporates. In just 4 months, foreign investors dump Canadian assets. Confidence in Canada? Well, obviously it's crashing. It's completely nosediving. The world sees Canada as a bad bet, currently anyways. The result of less capital is pretty easy to understand. It means fewer jobs, weaker markets, a failing dollar, and the worst part, Ottawa doesn't look to be repealing any of the harmful or prohibitive regulations and laws that have contributed to Canada being in this situation to begin with. Tying it all into real estate now, Canadians are looking to American stocks to build their wealth these days. How sad is that? Canadians increased their net position in US stocks by $14.2 billion in May alone. That's more than 4.5 times the volume last year. It was 88% higher than previous cycle peaks in May of 2021 and the biggest net increase for the month on record. When you combine skyrocketing taxes, reckless deficit spending, an $83.8 billion investor exodus, is it any surprise that Canadian real estate is caught in the crossfire? With less capital flowing in, more wealth fleeing to the US, and a government allergic to fiscal restraint, demand is going to weaken, financing is going to tighten, and confidence is going to collapse. The market isn't just cooling, it's being entirely chilled from the top down.
I think there's nowhere this is more pronounced than in the Toronto condo market. Urban Nation expects a total of just over 17,000 condos to complete in the second half of 2025, which would bring the total completions for the year to over 31,400 homes. Now, this is around 74% higher than the long-term average, which is 18,000. And 18,000 is actually the number that's currently expected for next year, for 2026. Now, unsold inventory across all stages of development totaled about 24,000 units in just Q2 of 2025. And this is actually a 3% decline from the record high reached just around 1 year ago. And the first reported annual decrease in unsold inventory in more than 3 years, right? We've all seen it just build and build over the last 3 years. So this has occurred as developers continue to pause new condo launches. We report on this quite a bit, right? Only 3 projects totaling 891 units launched for pre-sales in Q2. 3 towers. That's obviously incredibly depressed. Now, at the same time, there are about 64,600 condominium homes under construction as of Q2 2025, a big number. So there's a lot in the pipeline. And of course, with this climate, you understand why developers are pulling back and stalling or canceling projects. Now, once the above 17,000 odd homes complete in the second half of this year, there will be at least 47,500 new homes still under construction as we start 2026. If we do end up completing the 18,000 odd units next year, that will leave just under 30,000 units under construction going into 2027 now. If completions remain at similar levels after this, we could then be close to building our way through this condo pipeline probably by around the end of 2027. So it's hard to say, but by around 2028, we should be on the quote unquote other side of this market, right? Possibly back into a shortage as getting construction going again when there actually is demand for these type of properties. It takes a while, right? It takes a while to gas up those engines. So what's more, the extreme slowdown that we are experiencing in Toronto and Canada as a whole, well, the USA is experiencing it as well. Realtor.com just released their housing forecast mid-year update, and it projects that sales volumes for existing homes, essentially resale homes, are going to drop about 1.5% from last year to just 4 million transactions. And sure, that might sound high compared to Canadian sales, but get this. That number, 4 million sales for the whole year of 2025, would be a 30-year low, going back to 1995. So mortgage rates are a big influencer of the slowdown because the average 30-year term mortgage in the States right now, 6.7%. So you understand how that's a lot more invasive than what we're facing here in Canada. 4.2% suddenly sounds a little bit more appealing. Either way, the housing slowdown is not only national, it is international, and the States is experiencing it to a very high degree, a 30-year degree, in fact.
That's crazy. And it's funny when we tie all this stuff together, we look at, I want to bring it back to tax again, because the government here, obviously housing supply is a big, big issue here. And like you said, Dan, it's possible that by 2027, 2028, we might see the market begin to turn. And if we're going to do that, we're going to need supply, and developers are going to need to build supply at rates they can at least afford. So how is the government helping with this? Well, the BC government is lending a hand to the ailing home building industry in the province's most populous regions, effectively slashing development charges for many projects that are already in the pipeline. Residential projects in Metro Vancouver, initiated before March of 2024, will have the fees to pay for growth-related infrastructure such as water, wastewater, and parks reduced. Developers of these in-stream projects will be able to pay development cost charges under the old fee structure instead of the new one that has more than tripled this year. But this creates a new problem. Metro's funding shortfall from the reduced development charges will be backstopped by a whopping $250 million from the federal government. This will ultimately help developers bring product to market by having lower overhead, though we will experience a huge amount of inflation as a result of that. But the fees aren't being reduced. Here's the catch. They're being repurposed. And guess who gets to pay for that $250 million? You do. It's taxpayer funds that will be used to pay for taxed improvements, double tax. The outcome will be that some projects move forward, resulting in the retention of thousands of jobs in Vancouver, and provides a measure of certainty in an uncertain time. We'll see. But again, the change is unlikely to make a major difference for many Vancouver area condo projects, considering the state of the overall market. I mean, listen to what Dan just said, but it could come to help some rental projects get unstuck. If you remember, increased DCC fees were approved by the council in 2023 and represented increases as high as 255% over the next 3 years. They were implemented over the objections of developers and Canada's then housing minister, who cautioned the increases were so dramatic they would render several planned developments unviable. Under Metro Vancouver's new fee structure, which took effect January 1st, development charges for each purpose-built rental apartment more than tripled. They went from $6,250 per unit to basically $21,000. So what's happening here is perhaps a baby step in the right direction. It's more of a band-aid, in my opinion, that the government is realizing that these fees and taxes are too high. And it's not just them, too. It's for everybody. In finding a way to help homes get built, maybe, but at the end of the day, I still feel we're going to pay for this, whether it's through inflation, whether it's through high prices later on. I just don't see this as a solution. And, ultimately, the initiative falls short in that fees aren't being reduced. They're just being handed over to taxpayers. And that looks only to benefit rental units, which are currently being built at a record amount. We do fully expect to see further improvements in the amount of government fees required to build homes, but it'll take time because they're broke too.
So let's take a look at the rental market. As Ryan mentioned, we do literally have a record amount of rental units under construction, and it's going to dramatically shift that marketplace. So the July numbers just came out from our friends at live.rent, and they note that a 1-bedroom unfurnished rental in Vancouver, it actually saw rental rates increase last month. Well, marginally, $9, right? So the average now is $2,232. But yes, we are much lower than last year. We're down $129 a month from this time last year. West Vancouver leads the pack for highest rental rates with 1-beds at $2,617. But there were two other noteworthy elements that really stood out I want to share with you. Downtown Vancouver rents are up. So after dipping in May, the 1-bed unfurnished rent in a downtown Vancouver condo, it's risen now for 2 straight months, reaching $2,818 in July. It's up 4.1% since May. Rents are 2.9% lower than they were 1 year ago. But a 2-month increase is interesting, and we'll definitely continue tracking that. But on the other end of that spectrum, Burnaby rents fell very fast. Burnaby saw a 7.6 year-over-year drop in that same 1-bedroom unfurnished home type, where every major Burnaby neighborhood basically saw a rental decrease. Central Burnaby down 16% and South Slope like almost 15%. Those are the two leaders year over year in negative or lowering rental rates. Even Metrotown saw a drop down 9% year over year. And that's obviously one of Burnaby's most active neighborhoods. So while Vancouver's seeing a little bit of a resurgence in tiny pockets, but not much. Burnaby is currently taking the brunt at some pretty notable declines year over year.
Let's touch on home equity. So one element of Canadian housing that prevents it from truly crashing is the amount of equity that's involved. Today, the average Canadian has 74% equity in their home. And the average home in Canada is $691,000, resulting in about $500,000 in equity. And in Vancouver, the average price is $1.173 million, resulting in about $870,000 in equity. And this is partially why we see so few foreclosures, very stable banks, and with equity comes options.
I just saw an article come by in the news this morning right before we recorded, and it was about the essentially equity or the wealth gap in the States regarding homeowners and renters. And they said the average net worth of a homeowner in America as of basically July 2025 was $400,000. And at the same time, the average net worth of a renter in America was 10 grand. And that is growing. That wealth gap is growing down there. There was an article from 2006 that showed it a bit tighter. And I don't know, maybe we'll expand on this next episode. But again, just that disparity is immense between renters and owners. Now, let's talk a bit about mortgages, because this ties into it as well. So there is an interesting, dynamic, if you will, that's taking place within mortgage balances in Canada. Since 2022, just 3 years ago, the change in amount of average mortgage debt is actually increasing in people that are in the 55-year-old and older segment, and it's decreasing for those that are 35 and under. This is like a complete reversal of what we're used to. And you might ask, okay, why is this happening? And there's two sort of glaring reasons. First is what you've probably heard of a lot of lately is the bank of mom and dad. A lot of parents with a lot of equity in their home are dipping into it now to help their kids buy homes, to get into the real estate market. They either are extending or taking on a mortgage, or maybe turning or accessing a line of credit against their property to provide the down payment for the kids. And the second reason, of course, is, well, it's the sheer cost of living and all this taxes that we're talking about, right? Seniors, we are now seeing extending mortgages into their quote unquote retirement years and dipping into home equity to literally cover the cost of living.
You know, Dan, I think we talked about this on another episode earlier this year. And if memory serves me correct, by 1996, it was something like 4% of people in their 60s going into retirement had a mortgage. Then by 2006, it was 14%. And by this year, it was 28%. So it continues to climb and climb. I really want to stress the fact, I think that, you know, if the baby boomer generation intends to retire on the sale of their home, I hope that they have some other investments too, because these prices are unsustainable for the next generation to service without either having a ton of equity, like you're saying, getting transferred to them. We see it almost all the time. You know, for new home buyers in Vancouver, the average home price is 1.1 million. The amount of money required is big, right? So I suspect you're going to continue to see a waning in that, and it has to level out. Anyhow, that actually brings me to the next point, which is our real estate sentiment. After dropping to 3-year lows in the early days of the tariff talks, sentiment in housing surged in the late spring. It's since flattened out, similar to the marketplace over the past 2 weeks. And to be fair, by zooming it back out at like a 30,000 foot look, overall real estate sentiment is well below the normal levels. So I don't want people thinking in the comments here that we're talking about the market pumping. It's not. This is also demonstrated by the very low sales volume realized across the entirety of Canada.
It's almost like sentiment follows interest rates, which kind of makes a lot of sense. They're tied in. And we are going to finish this episode in interest rates, or about interest rates and the forecasts therein. Because one thing that's going to keep these real estate sales volumes depressed, both in the States and in Canada, is, let's call them quote unquote high interest rates. I mean, they're actually not that bad, but you know, historically, you look over the last decade, and sure, they're considered high if you only look at a 10-year window. And the big six banks have recently released their forecasts for interest rates between now and the end of 2026, right? So we have about a 18-month view here from all the banks. And we're going to share this on the screen for those watching the YouTube episode, but I'll just run through them quickly. We've got RBC saying that they expect no cuts between now and the end of 2026, where the interest rate will remain overnight rate at 2.75. Next up, we've got Scotiabank, who sees a quarter point cut at 2.5 by that time. Both CIBC and National Bank see it dropping to 2.25. And then we've got the most optimistic being BMO, which sees it dropping to 2.0. So 75 bips cuts over the next 18 months. Hopefully I saw them all there. It kind of overlaps a bit, but it goes to show you, right? Even the big six banks and their economists, I mean, they can't even agree between 2 and 2.75 is, you know, it's a pretty big gap there. But either way, you know, as a homeowner or as somebody with debts, or somebody who's looking to buy a home, sell a home, refinance a home, whatever it is, you basically have a forecast here that's going to show the overnight rate somewhere between 2 and 2.75 over the next year and a half. So that means the fixed rates are going to be basically, I don't know, mid threes if you're lucky, up to where they are today, sort of like low fours, 4.3s. That's kind of where it's going to be for the next 18 months based on the data we have today. So plan accordingly. Thank you, as always, for tuning in and watching. We will see you here next week, and have an awesome weekend. I don't think it's that long. I don't know. They all feel long in summer, but enjoy either way, and we'll see you here next week. Bye.